All right, good morning.
Good morning.
I am going to attempt to speak very loudly at you. We just learned the podium mic is not working, so I hope everybody in the back can hear. Excellent, excellent. So my name's Paul Jensen. I'm the Dean of the College of Business here at Drexel, and I first just want to welcome all of you. Welcome to Philadelphia, welcome to Drexel University, and welcome to the College of Business. And importantly, welcome to our second conference on sovereign debt restructuring. We're really happy to host this again. I want to, at the outset, thank the Global Interdependence Center for partnering with us again to do this event. This is fantastic. We do a lot of events in the College of Business, and as Dean, of course, I support all events, but as an international trade economist, I find myself slightly partial to events dealing with important international and financial issues. So thrilled that we're able to do this conference with you again. Our first conference covered the topic of sovereign debt restructuring in Venezuela, and obviously we're seeing this year the importance of that topic. Last year's conference outlined the challenges of providing a solution to a very difficult situation. Several speakers last year advocated for regime change as a catalyst for the country to handle its sovereign debt restructuring problems. Looking at recent events, it's clear that last year's conference provided forward-looking insight. I was also really pleased to see that out of last year's conference, we had a number of papers published, including papers in the Journal of Investing. I'm very confident, again, that this year our conference will provide valuable insights and will highlight the good work that has been accomplished by multilateral organizations such as the IMF, the ESM, the European Union, all related to Ireland, Portugal, and Cyprus. So as you strive to provide answers and solutions for real problems on sovereign debt restructuring, we at LeBow are educating future business leaders by instilling in them the experiences they need to move on and solve difficult problems. Some of our initiatives include our Drexel Business Solutions Institute, which highlights creative and impactful ways of building collaborations between industry and the university. It's clear to me, and it's clear to I think a lot of people, that higher education will see really significant changes over the next decade. And what is also becoming apparent is that this kind of collaboration with industry to prepare our students to solve the difficult challenges they will face in business and society going forward, that partnering with industry will be essential to effectively prepare them, particularly as the problems we face become more interdisciplinary and more technical in nature. So again, we're thrilled to be hosting a conference that is also looking at solving really important problems. I want to thank our two co-chairs for today's conference, George Tsetsekos, who's the Francis Professor of Finance and our former dean here at LeBow, and also Michael Papaioannou, who's a distinguished visiting scholar and professor of economics. So Michael and George, thank you very much. You've assembled an amazing group here to speak with us today, and really look forward to hearing their comments. I also want to thank Cassie Brown and her team. I think Cassie just stepped out, but no event here happens at Drexel and at LeBow without Cassie Brown's great work. So thank you, Cassie and her team. And again, Jillian, thank you for the Global Interdependence Center. We really appreciate the partnership we've had with you for many, many years, and thank you for working with us on this event. And then lastly, but maybe most importantly, I want to thank all of you for coming. I know many of you have traveled from abroad and from cities all across North America, so thank you for being here. We really appreciate the opportunity to hear the conversation today, and I'm thrilled to see that some of our students, our faculty, freed some of our students to join us today, and the chance for them to hear this discussion today is fantastic. So thank you for being here. Have a great conference, and with that, I will invite George to the podium. So thank you. Enjoy.
It's always wonderful to have to work with an individual who really is a great colleague, but fundamentally he commands presence because he's so tall on one hand, but on the other hand, he's so into international things. Of course, he's an international economist and always forward-looking. And I'm very pleased to tell you some things that he has done in such a short period of time since he became dean that he never mentioned to us. One of them is that he named the Center of Corporate Governance after Gupta. Mr. Gupta, an alum of the LeBow College of Business. He served as a CEO for Roman Haas. And not only that, but one of the key members of the Center in the Corporate Governance is Bill McNabb, Executive in Resident, just the recently retired CEO of Vanguard, and many, many other things in addition to the Business Solutions Institute that he's established just a year ago. Thank you, Paul, for all your support and all the great things that you are doing and you have done. Here in the LeBow College of Business, you know, I'm glad I'm not the dean anymore. It's very difficult to compete with those guys that they have more aspirations and great stamina and great work. But thanks to all of you. We have a great conference, a great lineup of speakers here. And I can tell you that I'm very pleased that we have 3 sessions in our conference that they will discuss various issues related to the sovereign debt restructurings of countries that they were under extraneous circumstances, under stress a few years back. And at the same time, we would have a very nice opening with a comprehensive review of the issues related to sovereign debt restructuring in the European setting. I want to primarily also thank my collaborator for many years and a great friend of mine, Michael Papaioannou, from Technical Advisor. This is his new role, Technical Expert Advisor. He always corrects me. At IMF and distinguished visiting scholar at the LeBow College of Business. An individual that I work with now as a co-instructor in my international finance class. Michael, the podium is for you. Go ahead, give us some of your remarks.
Thank you, George. I am not going to be taking the podium in the interest of time. Thank you very much for your kind words. And thanks again, the GIC and also the school here. For hosting this event, and thank you all for coming, and we hope that we are going to be having a very fruitful discussion and exchange of views. Thank you, and with that one, probably we should be moving to the
keynote speaker. Our first speaker is Kristian Orsini. He is the Counsellor of Economic and Financial Affairs from the Delegation of the European Union. And he's going to give us an overview of the European crisis. His bio is listed here, so for the best interest of time, I'm not going to introduce.
Perfect.
All right, thank you.
Thank you. Thank you so much. Thank you for the kind introduction. It's an honor to be here today. Let me just upload the There is a consensus which, in my view, is gradually emerging about what happened in the European debt crisis. But, I also think that that consensus took a bit of time to emerge. And there were some misconceptions about what was really behind, what were the triggers and what were the amplifiers. And that inevitably also had an effect on what was the policy response. So I think there is definitely value in seeing or trying to understand exactly what happened. And that's a value in per se. But there's one thing that we probably can all be sure about is this was not the last financial crisis. There are going to be more, most likely. And to that extent, some lessons probably have been learned, and probably some lessons, more lessons, can still be learned. So, at the core, virtual any financial crisis is the rapid unwinding of some imbalances that had been accumulated in the previous phase. And the size and the duration of the financial crisis, the gravity, pretty much depends on three factors. The size of the imbalances that were accumulated in the phase, and the triggers and amplifiers of the crisis, and the policy response. So this is a bit the outline of the presentation today. I'm going to say some words about the building up of imbalances, and then you cannot see it probably, but it's triggers and amplifiers. And then on the policy response, I will say something about the programs, but I understand there's much more qualified people to talk about the programs themselves, and go into the specifics of the three countries. So maybe I will say something more about the policy response at the EU level, which I think is something that, especially in the US, is not really appreciated. The extent of changes to the institutional framework that happened during this troubled period. So I will try to convince you that the debt crisis was not about public debt. So let me start with this. In this, here you show the deficits running from 2005 to 2007, and countries which stand out there are those countries which all ended up in a program, and they're all running current account deficits, right? Fairly sizable current account deficits. That's an average over the 3 years. Current account deficit, what is it? So it's when you import more than you export. Your export is a source of income, and your import is easier how you use the income. And when you are buying more than what you can afford, usually you say, well, I'll pay later. And that's the same for an individual. It's the same pretty much at aggregate level for an economy. And when you say I'll pay later, well, that basically means that you are giving claims on the future income that will be generated by the economy, either in the form of debt or in the form of equity. As it happens, it was more in the form of debt than in the form of equity. Sort of if you take the sum of your the assets that an economy owns in foreign countries, and you net out with the liabilities that foreign countries have on your domestic economy, you come up with the net international investment position, right? And that can be positive, basically, if you have been running current account surpluses for some time, but it can be negative if you have been running deficits for a long time. And as it happens, most of these countries have also been running deficit for quite some time. So the net international investment position was negative and strongly negative in some of these countries, okay? And as I said, most of it was actually related to debt and not equity. So basically, as this, as you are building up this debt, there is a capital inflows, which is the mirror image, which is coming then from other countries. Other countries being those at the core of the euro area. Where were these capital inflows going? Well, these show you the private sector credit flows in just before the crisis. So these are very large figures, and most of the peripheral eurozone countries had this very sizable investment, basically larger than the savings they were able to generate domestically. This is private sector. Public sector, actually, Ireland was running a surplus, Spain was running a surplus, Cyprus was running a surplus, Portugal was running a deficit, but this is like not that sizable within sight. And of course, Greece was a bit of a different case. But when we look at the overall debt position, the general government debt, again, we see that most of these countries came in with a very small, apart from Greece again, very small public debt as a share of GDP. Definitely much smaller than Italy, Belgium, France, Germany, and yet these were the countries who ended up in the crisis. So probably it was not about the public debt, right? So this is the summing up. There were these sizable capital inflows, the build-up of claims that were mostly intermediated by the banking system in the form of debt, mainly driven by the private sector, with the exception of Greece, largely bank intermediated. And where did this money go? I mean, because taking debt is not an issue if you can pay it back, right? But there was a lot of misallocation of this capital. A lot of it went into real estate. So there was an accumulation of debt without having the corresponding capacity to pay it back. And if you take all these elements together, these are the typical elements that you find in a balance of payment crisis. But balance of payment crises were not supposed to happen in the euro area. That was the whole reason for setting up the euro area, right? So this is a quote from the European Commission report, One Money, One Market, no, One Market, One Money, 1990, that basically, saying that major effect of the EMU, the European Monetary Union, is that balance of payment constraints will disappear. What you will have is that, whatever firm is viable will have access to credit because you remove this aggregate effect through the exchange rate. That happens through the exchange rate, right? So in a way, I here I picked two countries, but there was a very idealized way in which this was worked. I mean, basically, there would be an excess of savings in one country, and there would be an excess of investment in another country, and that would sort of flow freely in a very fluid way. But this is not the way it happened, of course, right? Because the excess of savings actually goes into, is aggregated through monetary and financial institutions, which are based, in this case, in Germany, and the excess of investment is actually dispersed. I mean, the financing is given by banks which are located in Spain. And how does the two match? As well, mostly through the interbank market. This is collateralized, non-collateralized, it's bonds, a lot more short-term than long-term, but it also had, there was also some sizable wholesale funding. In less extent, you also had some banks, large banks group, that were actually operating across jurisdictions, so that would be able to use like intra-bank transfers, but it was really sort of minor. So in the build-up phases, you had that a lot of the credit risk is not as dispersed as was imagined, but ends up being very much concentrated into these banks. And the trigger at one point is simply, credit risk. There was an appreciation that there is some credit risk because it's so much accumulated into the banking sector. So this market pretty much collapsed. Not collapsed from day to night, but we'll see it progressively disintegrate. And here I've put together a couple of slides show MFI, monetary financial institutions, so banks, loans to, so direct to companies, basically, based on the residence of the counterpart. And what is maybe, the choice of color is not optimal for today, but the darker blue light is the intra-E euro area, and the lighter blue one is the domestic. So of course there is a domestic bias, but we see that this domestic bias was actually disappearing in the first phase of the it starts from 2000, pretty much the year of introduction of the euro. Comes 2008 and 2008, we have a reversal, and this is also with cross-bank loans. We say the same thing. and other securities. So there was, a phase of integration of the financial markets across Europe, which is followed by a phase of disintegration, because there is a different appreciation of what the counterpart risk is. So what happens? Well, 2010, I mean, it's still, so we had this very sizable credit flows to the private sector. 2007, they start decelerating, but then 2011, 2012, 2013, they turn negative, right? Massive contraction of credit in the private sector, mostly, or in the peripheral countries, and including Italy, which has always been flipping between core and the periphery. While public deficits balloon, pretty much in the same period. And but what at one point, I mean, you have the public deficit balloon. Well, I mean, in the case of Ireland 2010, it's actually the public deficit is minus 35% of GDP. That is related to the saving of the bank. But for the rest, you have sizable deficits also in countries that had the fiscal space to use it. That's, for example, France. Italy would have liked to, but the fiscal space was simply not there. But what exactly, I mean, how did this spiral? Because you had, a fairly sound fiscal position to start with. And how does this all spiral out of control? Well, that is the peculiarity of the European area, of the euro area construction. And that was that, whereas these financial markets were integrated, were integrated through the banking sectors, but banks remained essentially national, in a sense that the supervision was national. If the bank was too big to fail, well, it would have to be rescued essentially by the member states in which jurisdiction it was headquartered. If there were, for depositors, doubts about the capacity of the bank to pay back depositors, there was not an insurance which was at the euro area level. It was the insurance was provided by individual member states, and as the sovereign, the government, has problem in rolling over some of their debt, we see that the supply of credit is simply not there. The ECB, because of its structure, cannot intervene to basically calm the markets. You have the spreads. The cost of financing for the states start increasing. And they start increasing quite rapidly. And then this doom loop starts spiraling. Why? Because, well, the banks also, which are operating in a jurisdiction, tend to be loaded with government bonds in their capital structure, right? And that, so basically, when the cost of the yields go up, the value of this bond starts decreasing. That further increase the counterpart risk, and increases the borrowing, the cost for the banks to access finance. Further contraction of credit, further decrease of economic activity, higher impact on public finances. So you see how this basically starts spiraling, and this is in a sense it's very different from what happened in the U.S. right? I mean, if you think of the financial crisis, you never had this kind of amplifier. I mean, maybe one good example is to look at the housing, the crashing of the housing market in Nevada, I mean, which was very sizable. But what you have is that if first of all, the banks that were providing those loans for those housing companies were not exclusively based in Nevada, but also even if the financing costs for the state of Nevada increased, this did not have any repercussion of the bank system, because the banking system is actually using the federal bonds as their in their assets, right, in their asset structure. So doom loop, and doom loop can spiral quite quickly because if in the case of a government, you have the maturity structure can be quite large. Maybe average 5 to 6 years. It's what needed to roll over all the debt. So even if 1 year you have the spreads going up, it wouldn't be that dramatic. But for the credit institution, it was a whole different thing, right? Because we see that this increase in spreads is bringing up the borrowing cost of the financial institutions, but they have much shorter maturities. A state maybe renews its old debt structure in 5, 6, 7 years. For a bank, it's maybe up to 10% every day, because this was a lot of on the short term, overnight, etc. So here, what I've plotted is you can see this as the financing. These are spreads of the borrowing cost of the sovereign with respect to the German Bund. It's just a way of normalizing them. You can think that in terms of the financing cost. And then you see that the financing costs start increasing. They started increasing already a bit in the case of after the Lehman Brothers bankruptcy. That's where there was a whole different appreciation of risk. But then there is in beginning of 2010, the Greek authority revealed the true entity of the deficit, which had been concealed for previously, and it's a staggering 12.7% of GDP. Spreads go up. Then it's clear that at this level of financing cost, given also the high the size of the debt, basically there would be a difficult very quickly for Greece to roll over its debt. So the first economic adjustment program is put up for Greece. And here you see the green is Ireland, start increasing as well. So that's for the time when Ireland falls. Slightly different, in the case of Greece, it was actually the sovereign that ended up bringing down the banks. In the case of Ireland, it was the banks that brought back the sovereign. It doesn't really matter, because this is the issue of the doom loop, right? It can start at one point, but because it's a loop, it then can spiral, and it brings both down at the same time, the banking system and the sovereign. Portugal follows, and here, sorry, I forgot to say that. The top line is this indicator of fragmentation. This is something that is computed by the European Central Bank. It's an aggregate indicator, but basically it's quantity-based, and it sort of measures the amount of cross-jurisdiction credit flows, or not only credit loans and bonds, etc. So we started from a pretty high level of integration, and then as we progress, there's this fragmentation which is happening, and fragmentation really reaches the highest at this point. That's when basically it was clear that the first adjustment program that was put up for Greece was not really sufficient. There is a second program which comes with a quite substantial haircut. So there is a debt restructuring. And then there is also a lot of contagion, because, well, if we have restructured the debt of Greece, then we might end up having to restructure a lot of other debts as well, right? And even then, I said in the beginning was a lot of counterpart risk, and a lot of the transactions were happening in the uncollateralized market. But if you start having now doubts also about the potential restructuring of debt, then this brings down also the collateralized market, and then you see that that's a whole different ballgame. I mean, the financial disintegration is really accelerating at this stage. Spain follows, and it's slightly different, and I would say why, but it was not a fully fledged macro-financial adjustment program. It was more a banking sector recapitalization. But ultimately very similar. Spain had to raise on the market about 4 to 8% of GDP in terms of debt to restructure, and at those spreads, it was just impossible to finance the cost was just impossible to do that. And then, finally we enter into the descending phase of the crisis, if you want. We had the speech by Draghi, the president of the ECB, and that is in July of 2012, where he basically said, well, within the limits of its mandate, the ECB will do whatever it takes to preserve the integrity of the euro area. And he's, in a way, stretching a bit the mandate of the ECB, because it's saying that, well, the integrity of the euro area is key in order to perform monetary policy. And also he buys the time for the European governments to come together with an agreement on the ESM, a fund of 500 billion euros, almost 5% of GDP, which can be used, accessed by distressed member states, right? Shortly after, Draghi basically says that, or announces the possibility that if a country accesses the ESM and subscribes to the conditionalities involved with its loans, concessional loans that the ESM will give, then the ECB can also start intervening with the outright monetary transaction, that is actually buying bonds on the secondary markets to bring down the financing cost. And in the end, it was never used. I mean, the ESM was, but not the actual OMT, outright monetary transaction, because you see that just the announcement, the power of this restores this kind of confidence, and you see also that this level of disintegration on the financial market started reversing. So, I mean, of course, there is a long tail of the event, and that is the Cyprus program, which was triggered, in fact, by the restructuring of the Greek debt. So that is sort of why it happened a bit later. But in general, you see, I mean, spreads go down, financial integration goes up, and then there is the first phase of the quantitative easing. So a lot of liquidity is finally injected into the market to overcome some of the problems with the fragmentation of the interbanking. And then, we have the end of the first, the third part, the third leg of the Greek program. And then before that, we have shortly after that, we had the Ireland exit the program, and then progressively all of the countries exit the programs, ending with Greece, who exit the program in July of last year. So the policy response. What all of that happened, I mean, I've alluded to some of the episodes, but there was a lot that happened during this crisis. A lot happened at the national level, but also a lot happened at the EMU level. So very quickly about the programs, and I think there will be plenty of opportunity to speak more in details about this. But these were the financial aid that was provided was condition-based, and the conditionalities were. In terms of fiscal consolidation, the repairing of the financial system, and growth-enhancing structural reform. Making sure that this economy would be rebooted and start growing again. The compliance with the terms of the loans were ensured by the IMF, the European Commission, and the ECB, which had ended up, of course, being quite exposed to all of these countries to some of the emergency liquidity that it had provided. And the payments were conditional on the successive reviews. So, in terms of just the size of the programs, they're probably some of the largest programs ever had in the world. In the case of Greece, this was amounted to 100% of its GDP. Part of it to IMF, most of it through euro area government. Through different mechanisms, because the ESM was only came into force in 2015, Dean, thank you. But in the meantime, there were sort of a different ways in which this sort of special vehicles through which this money was channeled. Ireland, Portugal, Cyprus, it's between 40 and 50% of GDP, so it's much smaller entities, and Spain, it's just 4% of GDP. Now this is only the public sources, right? I mean, we also, if you want to see the overall cost of the program, you also have to add to it the sort of the private sector burden sharing, and this is what you see on the sort of the light blue is just what was the public, and then I decompose further the private sector burden sharing, which was, the biggest rate was in Greece and in Cyprus. Very different. In case of Greece, it was actually the private sector involvement, which I alluded to before, which was the restructuring of the debt. So it was almost 50 or 70% of loss of the nominal face value. 40% of GDP, and the rest was converted into bonds directly from the ESM. But in the case of Cyprus, it's different. What was restructured was basically the financial sector, less so the state. So it was the two major banks, ING and Bank of Cyprus. The first one was resolved and separated into a bad bank and a good bank, and merged with Bank of Cyprus. But what was there was really the size of deposits. So this was the first case where the private depositors were bailed in. And that is for another $10 billion or $8 billion, and which correspond pretty much to half of the size of the whole cost of the restructuring. It's a whole different, of course, different structure here. In the case of Greece, it was it was mostly the bondholders, and this included also the banks, which in a way were compensated through the restructuring of the financial sector. And here, in the case of Cyprus, it is really depositors. These are households. I mean, it's only the part which exceeded the minimum, 100,000 euros. But that basically this was lost for some of the depositors, and for the other depositors, they got converted into equity, which was not worth very much. So, and to provide an assessment about this program, well, I mean, there are different ways against which you can try to measure the success of these programs, and one of them is market access. Then it's like how they perform with respect to conditionalities, and how the economies performed as opposed to how they were expected or projected to perform. In terms of market access, I mean, we see that of the 5 programs, all 4 have sort of recovered market access, and they now have a rating which is above or at investment grade. There are still, I mean, that's not still the case for Greece, and there are doubts about the long-term sustainability of Greek debt. I think it's fair to say that. These are not short-term, because a lot of the loans that they had are indeed from the ESM, and they are on concessional terms, so the financing cost of rolling over, I mean, the financing costs are very low, and because also these are very long maturities. But at one point where these will need to be rolled up at market, in the prime market, then of course there might be quite a big gap in terms of the financing costs. But this is still some time in the future, so we can relax for a moment. In terms of conditionalities, well, conditionalities, as I said, were fiscal, financial, and structural. When structural, I mean sort of supply side. And in terms of fiscal, I mean, I would say in general that the fiscal targets were achieved. But it just was much more difficult to achieve those fiscal targets than it was originally assumed. And that is because in this particular situation, I mean, it ended up, well, first of all, the whole environment, the external condition in which these economies were operating was much worse than was originally assumed. But especially, I mean, the contractionary impact of some of these austerity measures was also higher than originally assumed. That is what is usually assumed as a sort of the multiplier. The fiscal multipliers were probably higher than it was originally assumed. So by reducing every euro of cut of public expenditure decreases GDP by more probably than 1 euro, right? And that was especially in the case of Greece, especially in closed economies. On the financial side, well, the restructuring was more successful. And sorry, just in the case of Greece, as you see, it was maybe it failed or it's not a full task just because it has to go through 3 programs, and you see that the first program was not nearly enough to actually tackle the issues. In financial, as I said, well, a lot of it, the commissionariats were dealing with the cleaning up with the financial sector. Was some really the stated desire to downsize the financial sector, right? In the case of Cyprus, in the case of Ireland, we had the financial sector that was several times the size of GDP, between 4 and 7 times, and the idea was actually to try to bring down this financial sector to more normal leverage levels. A lot of this was also done through separating bad banks from good banks and recapitalization, improved monitoring. In general, it was successful, but one probably should also say that the contraction that this restructuring process created on credit flows was worse than expected. And it proved to be very difficult to restructure the financial sector and at the same time ensure that viable firms would still have access to the financial markets. And in the structural, in general, yes. I would have to speed up a bit. But projection versus performance, again, so growth, unemployment, and the external sector performance. Growth, it's definitely not a pass. We see that, as I said, this is the contractionary impact of the fiscal austerity was really much worse than expected, and this had a spillover effect on the labor market. More so, definitely so in the cases of a more closed economy. The case of Greece was, because it was less integrated in terms of import and export, and it was a more closed economy than this austerity ended up being much more pervasive. And then let me now maybe use the rest of the time to speak a bit about what was done in terms of the EU. So we already had, in terms of the EU, a way of monitoring fiscal performance. That is what is called the Stability and Growth Pact, and it is the European Commission that does it. It's actually monitoring fiscal development in member states. And there is sort of one prevention and one correction leg to it. But as we saw, that's not where the problem originated from. It was not on the fiscal side. It was on the private sector debt, right? So one of the first elements was actually to expand the whole monitoring capacity of the European institution to also have this MIP, which stands for macroeconomic imbalances procedure, to sort of cover not only fiscal development, but more broadly macroeconomic development, and at the same time strengthening the fiscal. So I don't know to what extent you have been following the news, but now there is also the capacity of European institutions to have a say on budgets before they're actually passed by Parliament. So there's a sort of a screening by European authorities of budgets before they're actually adopted. So this goes under the framework of the enhanced prevention. And then, okay, there was also some directives, some legislation which was passed in member states, but encouraged by the European Commission to strengthen the national fiscal frameworks. Some additional money were put into the EU budget for enhancing technical assistance, and because one thing that was noted during the program period was actually that some of the countries also lacked some of the capacities to implement the reforms. So that falls under the macro-structural chapter. On the financial part, and that's probably one of the most important things, that all the efforts were directed at trying to cut the ties between the sovereign and and the banking system. And that was done pretty much by trying to mimic some of the institutions that existed in the US, having a centralized banking resolution authorities, having centralized more banking supervision authorities. These are in place. The third pillar, which is lacking that, I will come to that later. And then there was an enhanced toolkit in terms of monetary policies, the emergency liquidity assistance, the quantitative easing, crisis resolution, the ESM, which, once you have access to ESM, the ECB can also trigger OMT, and this fund of the ESM can also be used to support banking resolution. What has been agreed, or almost, this is missing parts of the puzzle. So there is also a European deposit insurance. That was the third pillar of the banking union. So completely cutting sort of this loop and the strings that link the bank to the state. There are some disagreement about how this should be implemented and when, but in principle, there isn't been an agreement. A central fiscal capacity tried to absorb shocks, asymmetric shocks. And then the Commission is currently working on capital market union that is trying to make some of these financial flows less reliant on the banking system, so more in terms of equity. And this is what I call the missing link. That is sort of something that would bring an overall coherence to this whole package, and that is actually developing a safe asset for the euro area, and that would be important both for the fiscal, for the financial, for the transmission of monetary policy, and could become a source of financing or funding for the ESM. But I'm afraid that we are still a bit far from developing or agreeing over the euro area safe assets.
Thank you very much. Appreciate it.